Hey folks, welcome to the show. Hey Sharad, how's it going, man?
It's going very well, and we've come back after a little bit of a sidestep back to core finance and economics today.
Absolutely. I mean, it is as core as it can get.
Mm.
We have with us Colin Lloyd, all the way from the UK. I'm making it sound very dramatic. But yeah, I mean, all the way from the UK through a Zoom call. Colin, obviously, a lot of our readers already know about. We do have the privilege of publishing some of his work on Transfin. In his own words, Colin has been following the ebb and flow of financial markets for more than 30 years. He is the person behind In the Long Run, which is a macroeconomics oriented blog. He's been doing that for the past 10 years. Obviously, it's a great blog. We both actively
Yeah.
look at it to get a kind of vantage point of US and European markets. It's been ranked as a top 100 economics blog in 2020 by Intelligent Economist. And again, in his own words, he started it for a longer term macroeconomic commentary and guidance for financial market investors. So I'm tremendously excited to welcome him. Hi, Colin. How's it going?
Hi, Nikhil. Lovely to speak with you guys. It's actually sunny here, having been rainy for the last couple of days. We make the most of it at this time of year. Great to be on the program and look forward to digging into some of the big topics.
No, absolutely. The pleasure is all ours. And I think before we kind of just go into, what we were thinking of talking about, I mean, we'd obviously like to hear your thoughts on, how central banks have been generally navigating monetary policy in the US and European markets over the past decade. And obviously that has had a fairly heavy consequence, not just in developed markets, but as well as in the emerging end of the spectrum. But before we do that, just for our listeners, would be great to, just hear a bit about you, a bit of a background. I know you have kind of worn several hats over your career. I mean, you've been a financial markets participant as well as a commentator. So, just for the benefit of our listeners, I mean, if you could just share a bit of, detail on your journey.
Sure, absolutely. So, yeah, I started my career in the commodity business, real physical commodities, shipping stuff from A to B, chartering vessels, buying in those days, back in the 1980s, buying your bunkerage in the Gulf because it was a lot cheaper than trying to buy fuel elsewhere, doing part charter parties and full charter parties, and shipping things all over the world. After about 7 years, I came into the financial markets, which was a slightly odd step. But one of the problems for many people in the commodity markets is the fact that if you enter into a forward contract and the price goes up, quite often it doesn't get shipped. And if the price goes down, the person who's buying it complains about the quality. And that's just one of the problems with non-standardized commodities. So looking to financial futures and commodity futures, it seemed to me I'd found the panacea where everything was standardized and there wouldn't be any more arguments. It was a rather simple view, but I came into financial markets in 1987, just after the stock market crash, funnily enough. Starting in financial derivatives, mainly to do with interest rates, then broadened out into equity indices. After about 10 years of doing that, mainly talking with global macro hedge funds, so I had to learn pretty quickly what the world of macroeconomics was all about. I then switched to equities and built an equity business in equity finance. Did that for about another 6 years, and then jumped ship from the sell side and worked on the buy side for a multi-strat hedge fund. And from there went on to do consulting work with a number of startup hedge funds. Somewhere along the way, I'm not quite sure how, I ended up with an opportunity to start a foreign exchange business. So I got involved in the liquidity provision side of foreign exchange. That's sort of gathering together the prices from 10, 11, 12, 15 different liquidity provider banks and non-bank providers, and providing that as a stream of very tight prices to market participants. So that was a big departure in some ways, but it was also probably one of the few areas where I hadn't worked. I'd worked in commodities, I'd worked in fixed income, I'd worked in the money markets, I'd got involved in equity indices, in single stocks, in equity finance, and now late in my career I'm going backwards and into the most sort of efficient market of all, foreign exchange. After about 4 years, sold that business, and it was around that time that I came back to my sort of passion for macroeconomics, which I'd had all the way through the 1980s and 90s, and started writing this blog in the long run. And the idea was that when I'd started, there was so much information that was difficult to obtain. Even trying to get the IMF reports, you had to wait a fortnight, and you had to be a subscriber, and everything changed with the internet, and suddenly the problem was there was too much information.
Yeah.
And a lot of that information was put out by brokers who wanted to generate business. So it was short-term trading tips about this and short-term trading tips about that. And what I felt was there was a gap where no one had time to read the 50 pages from the IMF and the 50 pages from the BIS that were put out on a regular basis, not to mention the hundreds of other publications. So I started trying to filter all of that together and find the useful bits. Well, one person, it's impossible, but you start to find sources, and from those sources I really started the newsletter with a long form. I think the shortest article I've written is about 1,200 words, and the longest, I apologize to those who waded through it, was 5,000 words about global commodities. There's an awful lot of variety in there, and you don't know where to stop. Anyway, so that's my kind of history. Right now I'm looking at hedge funds, still talking to some hedge funds, and looking at macroeconomic trends, and trying to think about where the markets go next. The blog is about the nexus, if you like, between macroeconomics on the one side and financial markets on the other. So a market moves, why? Or a market doesn't move, why?
Right.
And looking at it in that sense. Anyway, there you go. That's a long introduction.
No, I mean, this is very helpful. And actually, I mean, when you kind of mentioned in the end that when the markets move, why? I mean, that pretty much characterizes the message. And looking at it from that perspective, we've kind of the last, I would say, 12 years have been a fairly interesting journey where central banks, be it monetary policy, have closely been now, kind of merged within fiscal policy in a lot of geographies. What started, as a low interest rate environment at the end of, 09, 10 as a reaction to a crisis now has become pretty much the norm. And a lot of the, I would say, expected common wisdom in terms of asset prices, underlying value has been skewed by this central bank action, which actually definitely has its own utility, but has also had its own, expected and unexpected side effects. And there was a time when there was always a differential between emerging countries and the developed world in terms of interest rates, which kind of was a theme for many foreign institutional investors as well, in terms of capital flow, where to lock the money when the rates go up and where to, draw it out when the rates go down. But even that differential is now getting narrower and narrower. What's your take on that? I mean, it's a very open-ended, big question, in a simplistic way.
Big question, and where to start. I was doing a little bit of research on when the first central bank buying of bonds started, and actually it was, I think, the 20th of March 2001, and it was the Bank of Japan. And for anybody looking at what central banks are going to do next, the Bank of Japan has been a good place to start. They're like the petri dish for every experiment in unorthodox monetary policy. They've moved on to buying ETFs of Nikkei 225 stocks as part of their endeavor to provide even more permanent capital to the market and keep interest rates and indeed even the stock market under control. Is this the remit of central banks? Well, that's a big political question. I don't think that's one that is easy to answer, and people get red in the face about it. It's what is really happening. I think one of the interesting things about the current crisis is quantitative easing and unorthodox policies have kind of gone global. Back in 97, 98, when the sort of Asian crisis hit, many emerging economies, the bond issuance was in US dollars because there wasn't a big enough local currency market. But since then, those capital markets have evolved. And with the COVID crisis, you saw a whole host of emerging central banks intervene, reduce their interest rates, and also start a bond buying program. Now, it's starting from a small level. However, that's where the Bank of Japan started, from a small level. How big a central bank's impact can be in a small emerging economy as opposed to the US or China, of course, is another question. But the fact is, every central bank is adopting the policies that the largest developed central banks have been using for the last few years. But as you rightly say, back in 2009, this was the reaction to a crisis. Unfortunately, once you've bought all those bonds, you have two choices. You either hold them to redemption and see them run off that way, or you try and sell them in the market and have the market collapse in your face. So central banks are kind of in what we call Hobson's choice. There's a film from years ago which explains that. It's difficult to know how central banks get themselves out of this problem. Mm-hmm. And for people in the asset markets, what it means is there's a put under the bond market, and if bond yields are so low that they're not worth owning, that's a put under the equity market as well. So you have this dichotomy. We have the worst potential depression, economically speaking, globally, certainly in any of our lifetimes, and yet the stock market is practically at new highs. Mm-hmm. And I was just reading that even emerging markets where you would have thought fears and worries about liquidity and all of that would have driven people running for safety are practically back at their post-COVID highs. The world seems mad, but it's because it's driven by a massive pool of liquidity and the continued support that central banks are offering, even if they haven't done very much in emerging economies. When you see the US going towards zero yields on treasuries, anyone who has a bond portfolio is going to move their money offshore. So capital flows, I think, have come all the way rushing back into emerging markets, which has done the job of those central banks for them.
I mean, one very interesting point that you mentioned in between was on the the stock markets are at an all-time low, all-time high. And I mean, that obviously you're alluding is kind of, there's a causality there, right? But
I think so, yeah.
As an investor, I mean, it's very interesting because one has many different schools of thought. If you look at pure play cash equities, people look at it from a technical / momentum perspective. People look at markets from a fundamental value perspective. Do you think now, because of that, because asset prices themselves have been are kind of at a premium artificially, is a fundamental view of looking at the market now getting more and more dated, and it's all about momentum and betting on that?
The further you get away from what looks like sensible valuation, the more you rely on the kind of greater fool theory. I can buy something on a PE of 50 and sell it on a PE of 70, providing there's somebody after me to come in and buy it. That kind of logic. But there's also the fact that the price of the stock market is very much a reflection of the alternative to the stock market. So what are yields on real estate? What are yields on government bonds?
Right.
What credit risk am I taking? High yield emerging market debt is still, you can still pick up bonds with yields of 750 basis points, which when treasuries are yielding, less than 1%, makes it an attractive proposition, providing the currency doesn't collapse. But if you look at what's happened to emerging market currencies, the index, after having a understandable sharp decline in March, recovered incredibly quickly because of the confidence that was brought back to the market by central banks globally. Markets always climb a wall of fear. That's not changed. The difference, I think, today is that the valuation metrics that people use become increasingly stretched. In the last decade, index investing has become more and more popular, partly because the evidence, the statistical evidence shows that, unfortunately, discretionary portfolio managers, by the time you've taken out the extra fees for their discretion, don't consistently beat the index. So that's one reason why investors choose index investment. But the other is the whole momentum thing. It's a self-fulfilling prophecy. The value investor approach has been in the wilderness for a decade. I've written on a number of occasions about the fact that one should be looking to value investing as a good defensive play when this period of excessive liquidity finally comes to an end. But I'm not going to bet when that period of excessive liquidity comes to an end.
It's funny, Colin, like a lot of investment banks, some of the young traders who've been, at their job for the last, let's call it 10, 15 years, have never traded in an increasing interest rate environment. They're so used to trading in a declining interest rate environment. It's a skill set that's probably non-existent in a lot of banking trading floors, right? And it'll soon evaporate as well. But it has to move, right? I mean, there has to be a time when interest rates go the other way, right? I mean, how do you break out of this? We talk about how much deficit, how much firepower people have in their balance sheets, how long they can sustain it. There's a fiscal ability from a fiscal standpoint to cater to that. Like, how do you get out of this? Or is this just going to be a status quo? Like, this just keeps on going, lending becomes easier, people pile on debt and asset prices froth up. Like, how do you break out of it? Like, do you see anything coming out of it?
On a market by market basis, you can see situations where interest rates will rise.
Yeah.
The knee-jerk reaction in March saw many bond markets have increases. Where an economy is reliant on natural resources or things like that, and you see a decline in the price of commodities, that will undermine their currency, that kind of thing. So all of those things that you see in emerging markets, it will still see increases in interest rates. In the developed markets, we have a very, very strong secular force, which is the aging population. The demographics means that, in theory, people should be moving more money into fixed income. The central banks, because they have fiat currencies and they issue bonds in their fiat currencies, are not at risk from the run on a currency like you saw in the Asian crisis in 97, 98. A lot of what's happening in the financial markets is, to quote, I forget which poet, the willing suspension of disbelief. If there's a loss of confidence in the US dollar, which is the world's reserve currency, everything could change. But at the moment, there doesn't seem to be any sign of that. Still, nearly 80% of world trade, I think that's the figure I last saw, is transacted in US dollars, despite attempts by other major economies to get away from that. The euro had a period when it was doing a little better, and now people have gone back to using the US dollar. I'm sure the idea of the special drawing rights at the IMF is beguiling to a lot of countries that would rather not have the US dollar in control. But I don't think the way trade is currently is going to allow that to happen. So as long as there remains confidence, and as long as every country is essentially expanding money supply. Others would call it debasement.
Yeah.
If you expand money supply, I mean, this is a tangent here, but is a 2% inflation target a good idea? Why not allow prices to fall? Well, the argument is all about the fact that if people think that prices tomorrow are going to be cheaper today, they won't purchase, and that will cause the economy to slow. I think that's fallacious myself. If I need to have chicken for dinner, I'm going to buy it whether it's going to be cheaper next week or not.
Yeah.
Now there are some things that I might defer my consumption of, but when my computer breaks, even though I know if I wait 3 years I'll buy it for 1/5 of the price, I'm still going to buy another computer. So I think there might be a near-term effect of that. But if you look at what's happened in Japan, where they've been dancing around deflation for about a decade, on or off, it's still a very much developed economy. It still has some great companies, and economically they're not where the Weimar Republic was in the 1930s.
Yeah.
And you talked about US and the role US plays in terms of not just the reserve currency, but general the policy of the Fed. And recently they made they moved from an absolute 2% inflation targeted regime to more of a flexible average 2% kind of a mandate, which clearly points towards probably lowish interest rates for the foreseeable future. That how do you see that affecting not just the U.S. currency but also emerging markets from a capital inflow standpoint?
I think the Fed want to give a clear signal that they're continuing to provide accommodative policy, and they will continue to push to get inflation higher. I'm not sure that the headwinds. We've had a supply shock and a demand shock from COVID. We've got the demographic forces in the background, which, whilst the US is slightly better from a demographic point of view than, say, Europe and particularly Japan, these are forces that are inherently deflationary. So is the Fed going to succeed, or are they just going to allow incredibly loose policy for the foreseeable future? And where will that policy, where will that inflation show up? There was an article written back in 1996. This is kind of frightening, by a friend of mine who had worked for Soros, where he said when they look back on the second half of the 20th century, the economic historians will point out that one of the great policy mistakes of central banks was not to see asset price inflation as part of the problem.
Right.
Yeah. Well, we're 24 years on, and they're not showing much sign of having learnt any lessons yet.
I mean, I would like to now go a bit into the recent few months. Like in the last 6 to 8 months, we saw, big interventions by governments as well as central banks as a response to the COVID crisis, and they have taken fairly different shapes across the spectrum. Like in the US, obviously the Fed took the lead, and they kind of directly expanded their balance sheets. I mean, you heard Fed was actually buying corporate bonds directly, supporting businesses straight up. In Europe, especially in the UK, we saw income support come in one way or the other, both from budgetary from the fiscal budget side. In India, it was a bit different. In India, the central bank did not directly intervene, but they went through the commercial banks, right? So, I mean, they opened repo windows for commercial banks to borrow and get good liquidity. And then the idea was that they would lend and expand credit flow. Now, me and Sharad, we often kind of, felt that was a fairly disingenuous way of providing any sort of instant relief, because effectively commercial banks are just rich in liquidity, and the credit environment doesn't just start functioning because you have a lot of cash. I mean, credit and cash kind of operate in fundamentally different way. And it was pretty common in India that banks were actually returning money back to the RBI, back through the repo windows. And so we kind of were feeling that why isn't the RBI taking like a more US-like approach of direct, urgent intervention rather than go through I mean, obviously, we're very different economies structurally, but do you take any sides in terms of which approach you think worked better or is better from a contingency perspective?
The problem with extending credit lines to the commercial banks is you can lead a horse to water, but you cannot make him drink.
Absolutely.
The idea of giving them the credit lines is so they'll lend freely. If you go all the way back to Walter Bagehot and his book Lombard Street, written in the late part of the 19th century, he said that the function of the central bank should be to lend at a penal rate against good collateral, but to lend. We've come a long way from that, and now it seems that the policy of the leading central banks is to lend against practically no collateral at no interest rate at all. The problem with credit bubbles is they get excessive due to fractional reserve lending.
Yeah.
And structurally we have a problem which isn't going to go away. The banks are commercial enterprises. They have traditionally borrowed short and lent long. That's the way they make money. So if the yield curve is practically flat, they're not going to make very much money. They are pro-cyclical in their borrowing, in their lending. As the credit bubble expands, so they lend more and more aggressively. The moment things turn sour, they pull in their, they pull the window shut and they stop lending. So they create the excessive cycle and they create the bust as well. Ways that you get around that: stop banks lending against fractional reserves. That's pretty draconian. Make them unlimited by liability. That's also pretty draconian, but that's those are two really good ways of stopping those credit cycles from getting excessive. I don't think that either of those things are likely to happen. Whether it's right that they should or not, a lot of people have debated. I tend to think, as a bit of a Puritan at heart, that that would be a better way of running things. A possible way around it is the discussions that are going on around digital currencies.
Right.
A lot of central banks, they have a particular privilege of issuing the currency and they don't want to lose control of that, but they're taking a leaf out of the cryptocurrency handbook, and if they can lend through the digital currency market, theoretically you can open your account with the Reserve Bank of India and I can open my account with the Bank of England, and so on and so forth. And if they want to make credit available, they can lend it directly to me, to you, circumventing the bank and getting you then get rid of the need for a middleman altogether. There's some interesting stuff being written about it, but I see this as a possible answer to the problems of intermediation between the people who really need the money and the central banks wish to get it to them. I think that there are all sorts of unintended consequences that come from allowing that to happen, which, as a proponent of free markets, I think is disastrous. But that's a whole nother political conversation.
I mean, from an intermediation perspective, but there have been degrees of intermediation, right, across the world. Is there any model that you liked more? Is there did you obviously you saw things? I mean, you obviously have a closer kind of I would say vantage point towards what's happening in the UK, rest of Europe, or US. But if I was to ask you, is there any particular geography who you think dealt well in terms of responding?
Well, it's interesting. The ECB response was more bond buying, a wider range of corporate bonds. Obviously, buying of corporate bonds by any central bank is good news for those corporates that can issue in the capital markets. If you look at the people who are most likely to be put into bankruptcy, they are the smaller companies, the greater employers in many ways. And since most central banks, at least either tacitly or de facto, have a have a job of trying to promote full employment in those economies, this isn't going to solve the problem. What it's going to mean is if I've got to choose between a private company that can't borrow in the capital markets and has to go to their commercial bank, or a corporate that can borrow in the capital markets and therefore have their bonds bought by the central bank, the larger companies are going to do better out of that. You're going to see the companies that can tap the capital markets taking over the perfectly good companies that just can't get access to credit. And so there's some unintended consequences, but in terms of the sledgehammer to crack a nut that the central banks have to use, buying corporate bonds is probably going to have a better effect on getting credit to where it's needed. The question is whether in doing that they prolong businesses that shouldn't be in business at all.
Yeah.
And that brings you on to that whole question of what is the correct level for interest rates. And you go back to Finance 101, if I put in a discounting rate of 10%, no project I ever look at looks like it's worth doing. If I put in a financing rate of 2%, everything looks worth doing. And the problem is, what's the right interest rate from a commercial point of view? Well, if the central banks are setting rates at 0, everything's worth doing. And it doesn't necessarily mean that everything is going to succeed. It also means that companies that should have gone bust years ago and make way for, new entrepreneurs hang on. People who want to bring new technologies, innovation, are unable to obtain the capital, and the trend rate of growth comes lower. And what we've seen is, in the last 10 years at least, since the financial crisis in 2008, you've seen trend rate of economic growth in a lot of developed countries come lower as interest rates have gone lower. Now, there's all sorts of reasons why that may be the case, but I think one of them is that interest rates are too low, which is a bit kind of contrary to common logic.
Yeah. And, historically, we've sort of looked at interest rates and unemployment, with the whole Phillips curve background or an inverse relationship. That sort of has gradually over time softened as well, right? I mean, the relationship sort of seems to be flattened, the curve, and that's something that you've written about as well.
It's there's a couple of papers out from the Fed just recently on the Phillips curve, which I haven't yet got around to reading. But I after 2008-9, you got all these people who had been in full employment suddenly becoming self-employed or part-time employed. Mm-hmm. So the employment numbers look good, but the security of your job is much less. Therefore, you're not going to ask for such a big pay rise, or you're self-employed, in which case you've probably taken a pretty major hit on income and you're trying to make ends meet. So in that situation, where's the inflation? But also in that situation, you can have what looks like full employment and, hey, no inflation. Why is that? Well, it's pretty damned obvious.
Yeah. And, when we talk about the various measures taken from COVID, and we've seen historically in times of recession, government really, ramp up their capital expenditure towards state-owned projects. That's something that, government of India is also sort of hinting as of yesterday. They've, decided to ramp up some of their spending. Is that a theme that you've seen in other markets as well, of government really trying to invest out of this slump and in process generate demand and just stimulate the economic activity?
We're back to the new deals that are going on. Back in 1933, FDR came to office, and what was it, 76 bills in 75 days or something like that. Yeah. So at a time of an unprecedented event like this pandemic, probably it's one of the few times that governments should be doing something with the fiscal power that they have.
Yeah.
I go back to Keynes's ideas that when things are tough, government should spend, and when things are good, they should reap what they've sowed. The trouble with that mantra is that governments tend to spend money when times are good and spend even more money when times are bad. And if you see sort of governmental spending as a percentage of GDP, it's been steadily on the rise, probably throughout my entire lifetime. And it's a flaw in democracy, I guess, but I'm not sure that situation is going to change. What do I think right now? I think that a lot of the government projects are essential for stopping economies from imploding altogether. I'm generally against government spending. I'd like smaller government rather than bigger government, because I think it allows free trade to take up the gauntlet and actually generate real economic growth as opposed to illusionary economic growth. But in the current situation, I'm forced to eat my word.
I mean, that's also kind of a function of the extent of development in the country, right? I mean, like I kind of had a very similar view, but then when I kind of moved back to India, I realized that government is such a significant source of employment for so many people here. I mean, it just has. I mean, I kind of I remember, like, as compared to the UK, the clout that the government has in a country like India is phenomenal. And I mean, you can obviously see that there's a certain lack of skilled labor. Those guys are never going to be absorbed by the private sector, where commercials and bottom line is a predominant criteria. You need a generous employer for them, right? And so here it kind of government. That's why I think also gets a lot of the onus from the perspective of fiscal expansion.
Long-term government planning to improve education is, I think, at the heart of what really helps an economy in the long run. I think Germany's focus on educational excellence started a very, very long time ago with Bismarck. And he did several things, including the first pension scheme. And it really, today you look at the quality of the population in Germany in terms of their ability to they're an educated society, and it's not perfect, and one can always make educational opportunities better, but that really should be one of the big focuses of government. And technology is a huge benefit in that regard. We're making jokes here in the UK about streaming services, and you can get Netflix for £71, you can get Amazon Prime for £79, or you can get a university education for £9,250. But there is a point in all of that, which is that since the invention of the VCR in 1982, we've been able to deliver video content pretty much anywhere. Even back in the 1980s, the UK had the Open University, where you did 2 weeks every year at one of the campuses that was vacated by the regular students, and you could complete a university education online. So, remotely. The technology we have today clearly allows all lectures to be delivered online, all teaching to be done that way. It's not as good as face-to-face, but you can deliver it to millions of people at pretty much the same unit cost. And that transforms the economics of education. It really is a case of us not having embraced it for the last 25 years in anything like the degree we should have done. It does, of course, beg the question of, do we need 157,000 economics professors when 1,000 of them are really good and the rest perhaps aren't as good as they should be? There are a lot of sort of side effects of moving there too quickly. But what I've seen with COVID is it's accelerated all kinds of trends, not least the trend towards online education. Everybody's got with the program. And there will be some huge economic benefits for particularly countries with a large population like India of disseminating education everywhere. 5 years ago, I did a MOOC run by the University of Michigan. It was a finance MOOC because I thought I was a bit rusty. I was. But one of the guys who was on the course, and we were chatting away online, was a Maasai tribesman from Kenya, who was learning about finance in order to bring microfinance projects to his village. I have to say, 5 years on, I still think that's one of the most amazing things about technology. Here I am sitting in London, and here's this guy, literally coming into the main village, getting online, going back to his village out in the savannah. We have some fantastic opportunities with technology to really improve the economic lot of a huge percentage of the world's population. So let's get with the program and get there.
I mean, in terms of last 6 months, the one predominant trend in venture investing in India has been so many ed tech companies are being funded. And, we have had I think at least 3 to 4 unicorns come up. So ed tech is definitely as a theme picked up here because, I mean, here it's always been a game of volumes here. I mean, very quickly one realizes that, irrespective of, like India already has the largest primary school education system in the world in terms of number of schools, number of teachers, number of students, but still it's not good enough, right, in terms of penetration or enrollment. And technology kind of shows the way around, and COVID has definitely made that mainstream, made it acceptable, rightly or wrongly. Obviously it has its own, I would say, implications from the perspective of quality of learning. But but that as we would say, is probably a first world problem. So first, it's about getting as many people under the map, and then one can also think of optimizing the mix. And the technology, it definitely plays a major role in the first part. On the second part, only time will tell if quality differential can also be met.
Yeah, I mean, there's a number of things that go along with that. The ability to actually get access to the internet in rural areas in particular. However, companies like Google, I believe, are flying the idea of air balloons to link up the entire globe. So, ironically, there may be better reception in rural parts of India than there are in parts of the home counties in the UK. But the next 10 years, I can see all of these things being adopted if technology is allowed to run its natural course. What's holding back technology is probably the amount of capital that is available.
Yeah.
And again, that comes back to the fact that a lot of companies that probably shouldn't be in business still are.
Yeah.
And they're doing things in the old way, and they're crowding out new investment opportunities. But technology looks to be doing pretty well despite all of that. And I say despite rather than because they're getting the capital investment. There should be more capital investment. There should be more opportunities for entrepreneurs. It's a sign of a healthy economy.
Yeah.
I think kind of just want to kind of conclude a conversation again on a more macroeconomic perspective. I mean, you were talking about Phillips curve earlier, right? And I was just thinking at that time that the entire narrative of globalization has also been challenged a fair bit in the recent past. And the fact that there was a time when you could have a brand in the US, have a factory or back-end operation somewhere in Asia, and who can actually have a certain amount of cost arbitrage by doing that, definitely also skews up the correlation between unemployment and inflation on a domestic perspective, right? Just the fact that you can leverage international geographies. Now that entire, and there's a geopolitical spin to it post-COVID. There's a lot of anti-China sentiment, which was already there. Now it has expanded considerably. I mean, within India, we just kind of, China has been one of our largest trading partners, and there have been the geopolitical tinge here also. So most countries are now looking inward, especially the large economies, right? So that inward looking view, do you think it will bring something like the Phillips curve, which probably originated in a different time, back into relevance?
To some extent it will, but we're back to technology again. The adoption of robotic manufacturing, the adoption of better just-in-time manufacturing techniques favor local over global. If you think about all trends, they tend to get overextended and then pull back. And I think one of the problems with a lot of the globalization that happened over the last 20 years is that companies ended up with incredibly precarious supply chains that relied on everything working seamlessly. And after 2007, 8, 9, a lot of the fragility of those supply chains was laid bare. Certain companies that really thought about dual redundancy and having a second supply chain in case there was a problem with their primary one did very well, but a lot of companies either couldn't afford or didn't have the time to think through those implications. And of course, they've reaped the whirlwind which has happened since then. You've then got the problem of the disenfranchised in the developed world, which has led to a lot of polarization of political views. There's a lot of talk about the fact that social media has exacerbated that trend, but again, we're now delving into politics rather than macroeconomic. I think what we're going to see is, after this correction in the trend towards globalization, I think, maybe it's that I hope, but I think we're going to see a more robust resurgence of globalization over the coming 10 to 20 years.
Right, right.
There will be more robotic manufacturing in developed countries, and that will be to the detriment particularly of employment opportunities in frontier markets. But I think that there will be definite benefits for emerging market economies to build more robust supply chains, and the trade between developed and emerging economies will continue to grow and expand. The difficulty will be that whereas 10 years, 15 years ago, one bought manufactured goods from China, the benefit now, because Chinese wages have increased, means that countries like India, Pakistan, and Bangladesh have benefited. But the companies that are going to do well, I think, in places like India are going to be those companies that add value rather than produce basic manufactures. That will, to some extent, pass to countries in Africa, I suspect, where there's a comparative advantage in cost of labor. But I think you will also find that manufacturing techniques in developed countries will steal some of that business back to local suppliers. There's a tiny little company that makes T-shirts on the Isle of Wight, which is one of the, funnily enough, although it's in the south of the UK, actually is quite a poor area and has quite a high rate of unemployment. And they produce literally order by order rather than a mass manufacture process. And okay, they're charging quite a lot, but they're very bespoke product, and the company is doing remarkably well, which, given that it's the Isle of Wight, has cheered a lot of people up. But that's just a microcosm of the trends which I think will continue towards more technology and manufacturing in developed countries, making the buy local type of mantra work because there's a comparative advantage, continued added value to products from emerging markets. I'm afraid for the frontier economies that may be a more difficult journey.
No, I mean, this was a super, I would say, it was also a remarkably optimistic perspective.
Oh, I am. It was Carlyle who dubbed economics the dismal science. I'm actually I'm a huge optimist about human ingenuity. It solves everything. I mean, here's a fact that I love. The price of commodities in real inflation-adjusted terms has been falling ever since the economists introduced their commodity index in 1864. They actually backfitted it to 1845. But the last super cycle back in the mid-2000s, when commodity prices surged, was coming off 20 on that index, which had started at 100 in 1845. So that's a testament to human ingenuity. You get periods when commodities go up due to crises, usually wars, but in the long run, commodity prices fall. And that's because we get better at harvesting an acre of land, we get better at digging holes in the ground. I suspect that's been the case since Babylonian times.
No, absolutely no. I mean, I would like to definitely share your view here, and no, this has been great fun for us. And interestingly, you kind of ended your conversation with the title of your blog itself in the long run. So I like that I like that touch as well. And no, I know probably it was not by design, but it came out, so that definitely was good. And no, thank you so much, Colin.
Yeah,
Thanks for
an inadvertent self-publicist.
no, but I mean, as long as it
Look,
fits.
guys, I really, really appreciated the time. It's been fantastic talking with you. Love what you guys are doing. Read your blog every day, and please keep me on your mailing list, because it's always great to get your perspective, which gives me a view into one of the largest and most important of the emerging markets. With that focus and that perspective, you're the people who are going to run the world in 50 years. So I watch you guys carefully.
Oh no, thank you so much. Really appreciate it. And sorry, Sharad.
Yeah, no, thanks, Colin. Thanks for your time. It was a thoroughly exciting chat, and we too are quite optimistic about not just globalization, but how things will work out. So thanks again, and it was great having you.
Yeah, and on that, we can probably call it a sign off. This is Nikhil Arora
This is Sharad Tupran.
signing off.